All right, so we're diving into Volatility Coaches of India, their take on the Indian stock market.
Really interesting stuff.
Yeah, they just put out their December newsletter, and it's full of, really insightful stuff about these RVCC parameters.
Yeah.
And especially for those of you, looking at investment decisions right now, going into the end of December 2024.
Absolutely. Yeah.
So what we want to do today is try to break down what these RVCC parameters are really telling us.
Right.
Without, getting too lost in the technical jargon.
Exactly.
So maybe you could start by kind of giving us an overview of what these parameters are designed to do.
Well, they're designed to try to help us interpret market volatility, and then use those interpretations to craft some potential investment strategies.
Yeah.
And Volatility Coaches of India has put together, kind of a really unique system here, kind of like having a specialized toolkit, to really analyze the market.
I like that. A specialized toolkit.
Yeah.
So let's talk about the tools in this kit. What are we looking at here? What are the parameters?
Sure. So we've got the classics like the PE ratio, the price to earnings ratio.
Right.
And the PB ratio, the price to book ratio. And those give us a sense of market valuation.
Okay.
And then we have the MG ratio.
MG ratio.
Which looks at market capitalization in relation to GDP.
Okay.
And then for momentum and volatility, we've got some really interesting ones. We'll be looking at the RSI, the relative strength index, the exponential moving average, or EMA. And then, of course, the VIX, the volatility index.
Okay.
And then to get a sense of how the big players are feeling, we'll delve into the FII, the foreign institutional investors, their net options outstanding position.
Okay, so that gives us kind of a feel for all of the different parameters.
Right.
Let's actually unpack the numbers now.
Sure.
What are the specific values from Volatility Coaches of India's newsletter?
Okay.
It's dated December 15th, 2024.
Yes.
How do they compare to the previous week?
Right. So let's start with the PE ratio.
All right.
Currently, as of the 15th, it sits at 22.8.
22.8, okay.
Which is a slight increase from 22.72 on December 8th.
Okay.
And so what's interesting here is even this small uptick could indicate, growing optimism about future earnings.
Okay.
It's a subtle shift, but it could be significant.
So a little nudge upwards on the PE, does that mean hold or consider buying?
Yeah.
What's the actionable takeaway here for an investor?
I wouldn't say it's a screaming buy signal.
Okay.
But it does suggest that maybe the market is kind of warming up to the idea of future growth.
Okay.
But again, we're going to combine this with other parameters
to
get a really clear picture.
Okay.
So now let's look at the PB ratio.
Okay.
That's also inched up from 3.68 to 3.69.
Okay, another slight increase. So is this mirroring the PE, or is there a different story unfolding here?
Right. So the PB ratio, it's more about the company's assets, right?
Right.
And whether the market is valuing them appropriately.
Okay.
So the small change, it might not be statistically significant on its own, but when you see both PE and PB kind of moving in the same direction,
right,
it starts to kind of paint a picture.
Yeah.
It suggests that maybe the market is reevaluating its perception of value.
Interesting. So two indicators potentially, hinting at a shift in market sentiment.
Yeah, exactly.
Now let's talk about the MG ratio.
Okay.
Volatility Coaches of India reports it's gone up from 108.6 to 109.17. So what does this tell us about the market's relationship with the overall economy?
Right. Well, the MG ratio, it can be a little tricky, right?
Right.
Because a higher ratio can sometimes indicate an overvalued market.
Sure.
But it's crucial to consider the context, you know?
Right.
And we're talking about India, which has a growing economy.
Of course, yeah.
So this increase could simply reflect that, robust economic growth pushing market cap higher. However, it's a parameter we're going to want to keep a close eye on.
Right.
Because if it continues to climb rapidly, it could be a warning sign.
Okay, so a potential yellow flag, but not necessarily a cause for alarm just yet.
Yeah, I think that's a good way to put it.
Okay, so let's shift gears to momentum.
Okay.
Volatility Coaches of India is highlighting a pretty significant jump in the RSI.
Right.
From around 53 to 65.
Yeah, that's a substantial leap.
Now, isn't that getting into overbought territory?
It certainly is. An RSI above 70 is traditionally considered overbought.
Right.
But 65, we're already in a zone where we want to proceed with a bit more caution.
Okay.
It doesn't necessarily mean a downturn is imminent.
Yeah.
but it is a signal to, look for confirmation from other indicators before, jumping in head first.
So tempering the enthusiasm a bit, even though those PE and PB numbers, were hinting at some positive sentiment.
Yeah.
What about the FIIs? Their net open interest in options has changed to plus 7.34 lakh. What's the story there?
Well, FIIs are often seen as the big fish in the market, right? And their moves can create ripples.
Yeah.
And this slight, decrease in their net open interest from the previous week, it might suggest that they're taking a slightly more cautious stance.
Right.
And it could be a reaction to that elevated RSI, as they might be anticipating a short-term bullback.
Interesting how these parameters are starting to connect.
Yeah.
And tell a more nuanced story.
Absolutely.
This slight FII pullback, possibly due to that overbought RSI, makes me wonder about the overall market volatility. What does the VIX tell us?
Right. Well, the VIX has actually decreased from 14.14 to 13.05.
Okay.
So this suggests the decrease in fear and the anticipation of less volatility in the near future.
So even with the market potentially getting a bit overheated, investors aren't expecting a major shakeup in the short term.
That's what the VIX seems to be indicating.
Okay.
But remember, volatility can shift quickly.
Right. Of course, yeah.
Now, before we move on to Volatility Coaches of India's specific market predictions, I want to touch on one more technical indicator.
Sure.
The 13-day exponential moving average, or 13 EMA.
Okay.
The Nifty 50 closed at 24,768.30.
Okay.
Which is above its 13 EMA of 24,483.35.
Okay, so quick reminder for me here. How do we interpret the relationship between the Nifty and its 13 EMA?
Right. So the Nifty trading above its 13 EMA is generally seen as a bullish signal.
Okay.
It suggests upward momentum and potential for further gains.
Okay.
But it's just one piece of the puzzle,
Right.
You want to combine it with all the other parameters to get that, comprehensive understanding.
All right, so we've got this mix of signals.
Yeah.
Some pointing toward potential growth and optimism.
Mm-hmm.
Others maybe urging a little bit of caution.
Right.
Sounds like volatility coaches of India's market predictions are going to be crucial in making sense of all this.
Absolutely.
So let's dive into those in the next part of our deep dive.
Sounds good. So volatility coaches of India, they get into market predictions by using something called the Buffett indicator,
Okay.
which compares total market capitalization to GDP.
Okay.
And they're projecting a potential market return, get this, of 5.1% per year.
5.1%. Huh. That seems, a little modest, especially with some of the positive signals we saw in some of the other parameters.
Right.
Are they being overly cautious here?
Well, they actually break down that 5.1% into its contributing factors.
Okay.
So they've got 7.19% for economic growth,
Okay.
0% for dividend yield,
Okay.
and then negative 2.05% for valuation reversed to the mean.
Okay, so that last one, the market's tendency to kind of revert back to its historical average valuation is really pulling that projection down. Okay, so even with strong economic growth, the expectation is that valuations might cool down a bit.
Right.
Interesting. Now, they also mention a modified model with a slightly higher projected return of 5.2%.
Right.
What's the difference there?
Well, the modified model basically assumes a less drastic valuation reversed to the mean.
Okay.
So it's negative 1.95% compared to the negative 2.05.
Okay.
So suggesting a slightly more optimistic outlook on valuation trends.
Interesting. Okay, so both models pointing towards, maybe modest returns.
Yeah.
But what I'm really curious about is, what do they recommend investors actually do with this information?
Right.
Do they give any specific advice?
They do. So Volatility Coaches of India provide some specific recommendations for different Nifty levels.
Okay.
So if the Nifty drops below 23,000,
Okay.
they suggest converting debt holdings into equity.
Okay, so that's a pretty clear buy signal. They're essentially saying a market dip could present a buying opportunity.
Exactly. Yeah, they believe that a drop below 23,000 would offer an attractive entry point for equity investments, and they get even bolder if the Nifty falls below 22,000.
Oh, wow.
Then they recommend buying even more equity, even suggesting maybe converting assets like gold and fixed deposits.
Wow. So buying when others are fearful, but does that align with their overall projection of modest returns?
It's about recognizing potential opportunities within a larger context.
Okay.
Right? They're focused on long-term gains.
Right.
And they believe that, these lower Nifty levels could offer significant upside potential.
Okay.
Despite those, projected modest average returns.
Got it.
And they also adjust their, fund recommendations based on these levels.
Okay.
So at lower Nifty levels, they advocate shifting from flexi-cap to multi-cap funds.
Okay.
Which showcases a more diversified approach.
Okay, so staying nimble and adapting to market movements. Do they mention any preferred sectors for the current market conditions?
They do. They highlight banking, finance, IT, and pharma as sectors they currently favor.
Okay, that makes sense. Now, that's all forward-looking projection.
Right.
Do they back this up with any kind of historical trend analysis?
They do.
How's the market actually performed in recent years?
So they provide a really detailed overview of Nifty trends from 2022 to 2024,
Okay.
noting periods of positive, negative, and neutral trends.
Okay.
So, for instance, they point out that, starting from January 23rd of 2022, the market exhibited a negative trend, bottoming out on March 8th, 2022.
Okay, so a rough start to 2022. Did things improve after that?
There was a brief positive trend in mid-March.
Okay.
Followed by a mostly neutral or negative trend in April.
Okay.
And then from May onwards, a more positive or neutral trend emerged,
Okay.
becoming consistently positive from June 19th onward. However, around August 21st, things shifted back towards a neutral or negative trend.
Okay, quite a roller coaster ride. Any other notable turning points they highlight?
Definitely. April 2023 stands out as a significant shift.
Okay.
The market turned positive for equity for the first time since December 23rd, 2022.
Okay.
Then on August 18th, 2023, the market turned negative for the medium term,
Okay.
although they emphasized a positive long-term outlook.
So a mix of optimism and caution in 2023.
Okay.
What about more recent trends?
Right. So positive closing signals appeared September 1st, 2023.
Sure.
And that positive trend continued.
Yeah.
However, October 20th, 2024 brought closing signals that suggested a negative trend for the following week.
Okay.
But importantly, from November 10th, 2023, positive signs have been consistent, indicating a potentially favorable environment, leading up to today.
Okay, so a mix of, positive and negative signals.
Yeah.
But with a recent trend leaning positive, it sounds like understanding the current sectoral performance is going to be key in navigating this market landscape.
Absolutely.
Did Volatility Coaches of India provide any insights into that?
They did, yeah. They really broke it down. They included in their newsletter a breakdown of various sector indices as of December 15th, 2024.
Yeah.
And with all the, key metrics, PE, PB, and dividend yield.
Right.
So this helps us see, where the action is, where things are heating up.
Right, absolutely. Yeah. And it's especially insightful when we compare the performance of, say, large cap, mid cap, and small cap indices.
Right.
For example, the Nifty Mid Cap 50 has a much higher PE.
Okay.
It's 49.79.
Wow, that's high.
Compared to the Nifty 50's 22.8.
That is a big difference.
Yeah.
So what's driving that higher PE in the mid-cap segment?
Well, it indicates that investors are, much more bullish on those mid-cap companies.
Okay.
Potentially expecting faster growth there. But of course, higher PE can also mean higher risk.
Sure. So it's a trade-off, but Volatility Coaches of India seem to be leaning towards that growth potential.
Makes sense.
Yeah.
Higher risk, higher reward, right? Is there anything else in the sector data that stands out to you?
Well, the Nifty Small Cap 100 has a relatively attractive dividend yield. It's at 0.96%.
Okay.
And this could be, particularly appealing to income-focused investors,
Right.
especially given the current low dividend yield environment we talked about earlier.
Yeah, for sure. Okay, so we've got, small cap offering some yield appeal.
Yeah.
Mid cap potentially poised for growth.
Yeah.
Large cap, providing that stability. It's really interesting how these sector dynamics play out alongside those, broader market trends.
It is, yeah, very dynamic.
Yeah, it's a lot to take in, but I feel like, going through this with you, I have a much better grasp on these RVCC parameters and what they're really telling us about the Indian market.
Absolutely.
And that's exactly the point, right? These parameters are really just tools.
Tools, exactly.
To help us understand these complexities and then navigate these potential, investment opportunities that are out there.
Yeah. Volatility Coaches of India really did a great job of assembling a comprehensive toolkit.
Yeah, it's like they've given us a map and a compass
Exactly.
to navigate this terrain.
That's a great analogy.
Yeah. But as we've discussed, the market is constantly shifting. So what's your advice for our listener, as they kind of move forward, armed with this, newfound knowledge?
Yeah, well, my advice would be don't treat these parameters as static rules, right?
Yeah.
The market is dynamic. It's always changing.
Yeah.
Stay informed.
Right.
Be aware of what's happening.
Okay.
Global events, economic indicators.
Yeah.
And most importantly, adapt your strategies.
Okay.
Adapt your strategies accordingly. Perhaps you're particularly interested in, the implications of that PE ratio, or want to delve deeper into maybe the pharmaceutical sector.
Yeah.
Keep exploring, keep learning.
Right. And that's, kind of the essence of the deep dive.
Exactly.
Continuous learning, continuous exploration.
Absolutely.
So for our listener, as you consider, your next investment move, I want to leave you with this.
Okay.
How might global events, economic indicators, really shape the Indian market's trajectory in the coming, weeks and months?
It's a great question.
Yeah, something to think about.
Yeah, something to ponder.
As you chart your course in this ever-evolving financial landscape.
Indeed. Yeah. Always keep an eye on the horizon, and happy investing.
Until next time, stay curious.